Good morning, everybody, and welcome to the last in the series of IMAP webinars on the advantages of being a boutique manager. On Monday, we dealt with boutique management in Australian equities. On Wednesday, we looked at the challenges of being a boutique manager attacking global equities. And today, we're really going to talk about two aspects of portfolio management. One is we're joined, as you can see on the screen, by three of Australia's leading portfolio managers. And each of them comes to us from straight out of advice to their approach to portfolio management. And we're going to be talking as well, not only about their own process, but about the use of alternatives within portfolios. Today, our moderator is Nigel Douglas, as it has been all week. And before I hand over to Nigel, let me just talk a little about the events of 2023. So we have a full calendar for 2023, starting in February with our virtual technology conference, 5 days on the theme of the technology and its role in sustaining a 20-year advice relationship. In March, we attack Portfolio Management Conference, where we'll be joined by 20 investment managers talking about their approach to investment markets at the start of what looks like a particularly challenging year. In April, the IMAP Awards open for award in August. Nigel, today's moderator, is of course a judge of that of the awards. And next year we'll be introducing a new category for boutique licensees. So that's licensees who come at this with a much smaller business orientation than others. In July, Advice in Action, where we deal with issues around the use of managed accounts in advice practices, practice management, the commercials of licensees. We'll be looking there particularly at the strategic drivers of success in advice businesses. And then our final two conferences for the year will be Independent Thought, where portfolio managers such as the four who are joining us today, Nigel, Dinyar, Shane, and David, will have a chance to showcase their thinking about key investment issues. Now, of course, you're all familiar with how to ask questions, but just a quick reminder that we encourage questions. And if you have something that's of interest to you, don't hesitate to submit them. So it's without further ado, let me hand over to Nigel Douglas, the moderator of last in this week's webinar series. Thanks, Nigel.
Thanks, Toby. First, I'd like to formally introduce the panel. We have Dinyar Irani, Chairman and Co-CIO in Innova Asset Management, David Matesic, Portfolio Manager, Atrium Investment Management, and Shane Hawke, Head of Portfolio Advisory, Oreana Portfolio Advisory Service. Welcome to you all. Now, to set the scene, first of all, I'd like to ask Dinyar, as a boutique manager running diversified portfolios, what is your investment philosophy and process?
Sure. Thanks, Nigel. Look, as a boutique manager, we've been working with advisors, financial advisors, for the past 20 plus years, and you know, it was part of our genesis, I suppose you'd say, to try to, through those dealings, try to speak with advisors and understand what the problems were that they were facing in running portfolios, etc. And one of the things that became very obvious to us was that traditional approaches to running portfolios weren't necessarily addressing the client's end needs. And so as a boutique, we were able to, I guess, pivot and and look at building portfolios in a different way. So we still run traditional portfolios, but we also run what we call risk-defined portfolios, where instead of having traditional market benchmarks, they have risk-based benchmarks. And so I guess that's one thing that as a boutique you can do relatively quickly and efficiently, as opposed to being a big institution. So we were trying to solve for using dynamic asset allocation really to address downside risk and to manage risk for clients so that they can stay on the journey towards reaching their financial goals without necessarily, being unsettled by market gyrations, so to speak. So when we were building the process, we really were looking for things that had strong evidential backing. Everyone has an opinion on what they think might happen and why things might happen. But we wanted to build a solid process that actually, had plenty of academic evidence backing it. So, basic things like, price drives long-term returns. Asset class risks are driven by their underlying factor risks, so people often wonder why, when markets hit a stress event, why correlations suddenly, rise and go towards one across asset classes, even though they believe they've got a diversified portfolio. So we wanted to actually dive into each asset class, understand what its key drivers are, and build portfolios that are truly diversified, not just diversified at a in terms of the labels on each asset class where people think they've got diversification, but when it really matters, they don't. So we've got a strong focus on price, and the price you pay drives the long-term return you'll get. You can do quite well out of buying, poorer quality assets, cyclical assets at the right price. You can do very poorly out of buying great assets at an inflated price. So we strongly believe that, asset allocation is the key to delivering, appropriate returns and effectively managing risk in portfolios for clients. And we've built a robust process around, valuing different asset classes, manager selection, again, taking opinion out of things, letting the quantitative work do, show us the results, and then exercising a qualitative framework over the top of that to knock out potential risks, etc. And that's what we've been doing for the past 12 years. We've got an 11+ year live money track record. That's quite a good one. And the advisors who've used us, feel very comfortable with that track record and the way we've, stewarded their client capital over the past 11 odd years. So yeah, that's us in a nutshell.
Okay. Thanks, Dinyar. Shane, what's Oreana's perspective?
Thank you. Yeah, so we have first step of our process is to understand the advisor's advice business mission and objectives. With that, it effectively is looking at what's the investment problem that they're trying to solve for. So if it is to get a expected return over a period of time of 5, 6, 7, 8%, whatever it might be, then we put together an investment philosophy that aims to meet that particular investment objective. So our philosophy that we work through, the core tenets of it, are effectively that markets are not always efficient and can be mispriced for significant periods of time. Some would argue we've seen some of that more recently with fixed interest markets in particular. We also believe that asset allocation to diversification are the most important elements of achieving your long-term return. We also have a view that markets can be dynamically allocated between sectors, investments, because conditions change over time. Again, we can point to fixed interest as being evidence of that, of significant dislocation, but also change over time. So having an ability to dynamically allocate between asset class, sector, and investment, we believe is important. Costs clearly matter. So for us, that's a key factor to consider in your decision making. We have a preference for a longer term time frame because we believe that the investment outcomes can be more certain and robust over long periods of time. So there's some of the key philosophies and cornerstones of our beliefs. And for us, it is about, similar to Dinyar, having evidence to demonstrate that there are processes that we can put into place to ensure that we get those outcomes. For us, the process from those philosophies comes down to three key areas, and that's looking at the strategic asset allocation. So we would be focusing in on a diversified portfolio because we have a view that strategic asset allocation is the primary contributor to the variability of returns over time. And so that is a key area for us to build to meet that mission and objective. Second to that, we have a dynamic asset allocation overlay, which is looking at trying to understand the mispricing between asset class. And we do that using Sharpe ratios over a 5-year holding period. More recently, we've had positions, we can talk about that at another time, around sovereign bonds versus credit versus equities, etc. So there is some mispricing opportunities that we are looking to either protect on the downside or actively add value via dynamic asset allocation. The last one is implementation and manager selection. That's where the cost comes in. So we came to market looking to provide choice, not necessarily just one solution, but a range of solutions. So with those portfolios of strategic asset allocation dynamic, you can implement them via a low-cost index-like implementation, a beta-type portfolio, a traditional core and satellite portfolio, and a more active portfolio. So our philosophy is very much a traditional diversified portfolio, which is looking to aim to meet an investment objective over time. You can use the same traditional risk profile framework. It's just a solution that's been built. Alternatives, which is obviously a topic for today, is an important element for us in our diversification. And we have allocation to alternative managers to provide and help us manage risk-adjusted outcomes. And so that's important for us as well. We will dynamically allocate between particular alternatives, and that's really a function of looking at getting an expected return for a level of risk based on where the mispricing is for traditional asset classes, such as fixed interest. So we've used alternatives there to assist us in that particular area. So our philosophy and process is essentially in that area.
Thanks, Shane. We'll explore the alternatives issue in more depth going forward in the next few questions. But are you using inflation plus objectives for the risk profiles?
No, we have an objective which is cash plus. We think that's and that's over again the investment timeframe that we have for the portfolios. So cash plus a 3.5–4% type return. And yeah, so it's probably different to some of the inflation plus type solutions out there. We just feel that that's easier to manage and is more consistent with what clients are typically expecting with term deposits and different things that are out there.
Yep. Okay, David. Atrium's approach.
Thanks, Nigel. So at Atrium, we've got a risk-targeted approach to investing, which means that when we construct our funds and portfolios, we target a level of portfolio risk on average through the market cycle. And they vary from, say, 5% volatility all the way up to 9% portfolio volatility on average. And then when we move sort of towards the portfolio construction part of our philosophy, of our process, we have a big emphasis on obviously being truly diversified. We have a big focus on quality and consistency of returns through the cycle. And we also see dynamic asset allocation playing quite an important role. And we've actually got a dual, I would say, objectives for each of our portfolios and funds, which is not only to deliver positive cash plus returns through the cycle, but also to deliver them within those set volatility targets that I mentioned before. So it does make it a little bit more, I would say, trickier than just being focused on returns. But by having that focus on managing portfolio volatility through the cycle, It means that we have a really big emphasis on risk management, and I would say being truly diversified. And so for us diversifiers, and especially liquid alternatives, I would say, play a really important role in our portfolios in managing that overall portfolio volatility, but also in helping us deliver to those cash plus absolute returns that we're seeking. I would say probably the last 12 months in particular have highlighted the importance of being truly diversified. And a lot of funds that have probably been seemingly diversified have been, have fallen a little bit short. So in the last 12 months, we've seen bonds negative, we've seen property negative, we've seen credit negative, we've seen equities negative. And it's been really reassuring to see that a lot of diversifying or liquid alternative strategies have been able to deliver positive returns in that environment. And so that's been a really good proof point, I think, for alternatives in this recent cycle, and is a reason why they form, quite a large, I would say, part of our portfolio today and going forward, especially managing volatility and downside risk. Just a little bit on Atrium. We've got a greater than 10-year track record, and we manage approximately $2.5 billion, I would say.
And just volatility is quite a technical concept. How do you find clients grasping that concept over time?
Oh, look, I think having those volatility targets and being able to achieve them and actually showing them that, through the cycle we've, managed portfolios to those limits has probably been, the key proof point for a lot of clients, I would say.
Okay, good. Now, Shane, how would you define the alternatives universe in the context of managed accounts? Oh, you're on mute, Shane.
Thank you. Yes, it's an important question. So I think that it's for us, we're very focused in on implementing to be consistent with the expected returns and areas that we're looking to invest. So whether that's a strategic asset allocation of Australian equities, small caps, whatever it might be, we're wanting to implement to get that exposure. So the strategic asset allocation is important for us. An alternative is looking to provide you, for us, an alternative exposure to those traditional asset classes. And for us, it's a case of looking to identify different ways to get uncorrelated returns and lower the risk that clients are potentially going to receive in those investments over the period of time. So for us, it's not an index-like return portfolio. It is looking for something which is differentiated in terms of its investment objective and outcome, giving you a different outcome. And so with that in mind, what we found over the years is that in my experience, there are some challenges with getting that exposure, both in terms of growth alternatives, but also defensive alternatives. So we've looked to try and provide a distinction between a growth alternative and a defensive type alternative, or an alternative that is looking to replace your fixed interest part of the portfolio. What we find is that a lot of alternative managers will have a volatility target, and so that is one measure that can be used, but often will have a return target which can be quite high as well with regard to their objectives. And so we've found that identifying a difference between growth and alternatives for us is to come up with a definition. And what we look to do is to provide managers with a volatility of lower than bond-like returns, with correlation benefits, and with some downside protection. And so that's how we define the difference between replacing or a difference between a fixed interest alternative and a growth alternative. So we don't just bucket them all in the one group. We have a specific role. So we want a fixed interest alternative manager to deliver when we need them to, like last year, great example. So we do split them out there. And so that's how we would define them. Just in terms of this as well, it's a tricky and difficult area because we would argue that some long-short managers have some alternative-like characteristics, but may have a benchmark of the standard index. We also find that some alternative managers are truly alternative in probably institutional markets, but coming out of things like asset allocation reports will come out as fixed interest or international equities. So in my experience, it's a very tricky and difficult area to define alternatives in the retail marketplace. But the way that we look at it is looking at what particular outcomes and exposures are we looking to get. Going back to our process, strategic allocation is the key. So we're looking for something different to that. And so we then narrow the universe down to looking at, as I said, different managers with different exposures to whether it's fixed interest or growth, lower volatility than bond-like returns for fixed interest, and correlation benefits and downside protection. There's some of the tenets that we're looking for alternative managers.
And are you finding enough managers there to build diversified alternatives portfolios?
Short answer would be no. So I think in this area that in my experience, this would be just a general comment that I think some of the alternative managers have been challenged in delivering consistent outcomes over periods of time. Over short periods of time, they can perform really quite well, but consistently, it hasn't necessarily been the case. So I think in the Australian marketplace, we've probably been, in my experience, probably underwhelmed with the array of alternative managers. Having said that, if you do your research, we believe that there is some very quality managers, and if you're very focused on their role in the portfolio, they play a very important role in a diversified portfolio. But to answer your question, no, I think it's been a difficult area. I've obviously been in the industry for some time and seen a lot of different market cycles with alternative managers promising a lot and not necessarily delivering. So been quite cautious to be honest with regard to alternatives and they're not all the same. And it's really important, I think, to understand what their role is in the portfolio and ensuring that they can deliver that on a consistent basis.
Okay, thanks. Now, David, I noticed in one of your portfolios, you've got about a third exposure to liquid alternatives. Yeah. So in defining the alternatives universe, I mean, what sort of categories do you think about?
Yeah, sure. So we actually put them in the diversifier bucket. So we don't differentiate between defensive alternatives or growth alternatives. So they're all in that diversifier bucket. And for us, what we're looking for are managers that have very low correlation with your traditional asset classes. So more importantly, with equities, I would say. So we're not looking at buying expensive traditional beta, if you could say, or paying a lot of money for just getting equity beta through the cycle. So for us, having that low or close to zero correlation to your traditional, especially equities, is obviously important. We're also looking for, I would say, alternatives that can stand up on their own 2 feet. So we're looking for ones that can still generate those positive cash plus 2, I would say maybe 5% returns through the cycle. So we want them to be generating a positive return. So we're not looking for those tail risk hedging type strategies in that bucket that have a negative return. And for us, just not wanting to repeat what Shane's mentioned, but for us, an important element of the diversifiers bucket is that they don't have coincident drawdowns with equities. So what that means is, we want them to be lowly correlated with equities, but when equities are down a lot, like they've really got to perform well. And so, obviously when equities are doing well, we want to maybe capture a little bit of that. But yeah, coincident drawdowns for us or coincident drawdowns with equity drawdowns is sort of the key factor for us going forward.
Do you look at multi-asset or multi-strategy type hedge funds?
At the moment, we haven't got any multi-strategy hedge funds, but there's sometimes they're a little bit difficult to model, I think, and a lot of them have struggled, I would say, to deliver that consistent return. Sometimes it's hard to put together top teams in all the different categories and to bring that all together. Maybe groups like Millennium maybe have done a great job there, but I think it's been a market that's struggled. But look, looking ahead, it's definitely not off our radar.
Okay. Dinyar, what's Innova's thoughts on this?
Yeah, sure. I mean, look, we keep it relatively simple, and I'd resonate with some of the things that David was saying there as well. Basically, when we're trying to define alternatives, we're looking at things that aren't correlated with the major asset classes. So, is their return largely explained by equity market beta or duration or credit risk? And if not, then if they're able to demonstrate uncorrelated returns, then we classify them as an alternative, not necessarily lumping them in defensives or growth alternatives. What we don't consider to be an alternative is what some industry funds and other people sort of look at and sort of say, hey, this is an unlisted asset, therefore it's uncorrelated or less correlated, and you kind of go, that doesn't wash. So we look at that. We're very conscious of these. There's a lot of long short funds out there that still are largely biased towards equity market beta, and we're very focused on these. So at the end of the day,
what about liquidity, didn't you? I mean,
yeah, we want daily liquid.
This asset class
priced.
is prone to freezing. Yeah, sorry.
Yeah.
Mm-hmm.
We want stuff that's truly daily liquid, daily priced, transparently priced, and more than anything else, when we identify a strategy, we want to know, why should this strategy get paid over time? Why should these returns persist? Why will it continue to be uncorrelated? So we're conscious of lots of things. We're always looking at managing risk, but it's not easy to identify liquid, transparently priced alternatives that are available on platforms, etc.
Okay, so David, turning to the practical considerations of implementing your strategy in the alternatives area, what are the key points that you focus on?
Yeah, so I was going to mention today some of those big trade-offs between, say, large and small groups or alternative managers in particular. So what we find is some strategies are probably more conducive to having larger teams. So those multi-strat funds we mentioned before, more quant types funds where you need a big research team to be constantly enhancing the models, improving the models in order to continue to deliver alpha. So like quant macro strategies or global equity quant market neutral funds, where it probably is quite conducive to have large teams. On the other hand, I would say some equity long short managers with close to zero equity beta, probably in smaller markets like Australia, having smaller teams sometimes it does tend to work much better. You don't need to have that huge research team or effort. One of the other things we notice between large and small is that smaller funds actually tend to have a higher concentration of employee ownership. So there's more alignment we tend to find sometimes with smaller funds. They've also got more skin in the game in terms of having bigger personal investments in some of these managers. So on average, smaller funds sort of seem to have the, I would say, advantage over larger funds in that alignment department. So that sort of offsets that sort of personnel difference between the two. And then finally, a really important risk for especially alternative managers is on the operational side. And so having a larger shop, they do tend to have best practice sort of operational capabilities, and that can vary from the back office or on cybersecurity. And so we find, a lot of the bigger shops, are really well sort of rehearsed and have, really strong capabilities in that areas. And that's probably an area where a lot more of the smaller guys, struggle, I would say.
In managed account space, do you have a wide enough range of managers you can invest in, or is that universe quite small?
Oh, look, we do have a relatively wide range where we've, got a couple of weekly priced funds that we can allocate to. You always want to get more strategies available in managed accounts, but obviously, given the liquidity on some strategies and lockups, it's hard. Look, I think we can do a good job. But yeah, there are some constraints there, definitely, in sort of accessing a lot of the, really, I would say, interesting liquid alternative strategies, I would say, like some of those global macro discretionary, perhaps, where, it's really hard to get anything less than quarterly lockup.
And Dinyar, how critical is liquidity when you're putting together a portfolio?
Well, it's horses for courses. I mean, on our sort of standard portfolios that we make available on public menus, we like to sort of stick to the daily liquid, daily priced stuff. For private labels, provided the advisory group that wants the private label understands the ramifications of having something that might not be daily priced, daily liquid, in terms of period of time it takes to rebalance, pension payment sort of issues and things like that. Look, so we keep an open mind, but for the standard portfolios, we try to stick to daily price, daily liquid transparency.
Do you get sufficient information, and to make those decisions?
Yeah, I think so. And in terms of the other question around, limitations and considerations, the universe is okay at this point in time. It's getting better over time. More and more things are becoming available. And I think as platforms make greater availability to offshore listed ETFs and things like that, it'll just continue improving.
Okay, and Shane, what operational due diligence does Oreana undertake when selecting managers in this space?
Yeah, so there's probably two things to think about here for us with looking at implementation in the alternatives. It's the structure. So in the managed account structure, I think has been communicated now, the importance of liquidity is key, and the operational due diligence tends to lead you towards a larger firm in that particular area. With our structure and strategy, though, we would be looking to make available a more diversified strategy in terms of the managed account is one solution, but we'd actually look to suggest and make available alternatives outside of the managed account. And we think that by doing so provides an opportunity to give you less liquid strategies for specific time periods which are relevant to the client's needs. And to my point earlier, some are more in income-like type alternatives or fixed interest-like alternatives, and some are more growth alternatives, but very traditional investment strategies, but not necessarily in the managed account. So, and I think then from that perspective, that leans you towards different opportunities to look at. And operational due diligence, therefore, is not necessarily as focused in those areas on the liquidity constraints and challenges of a managed account, but on other operational due diligence areas. Things like capacity is important as well as fees. And I think fees was brought up earlier as well. So we would look at some of those things in terms of the practical considerations of implementing alternatives.
Just on the fee side, fees are known for being pretty high in alternatives, but when you think of the overall fee you're charging clients for your diversified portfolios, does that limit your exposure to alternatives potentially?
Well, for us, the short answer would be no. We provide 3 different solutions. a low cost beta solution. So very index-like with a dynamic asset allocation overlay. Very low alternative exposure, liquid alternative in there. And then we have a core and satellite solution, which has a little bit more alternative. And then the unconstrained alpha portfolio could have a higher amount of alternatives if we found that we needed it, based on our views with markets and the diversification needs and the risks that we see in markets. So it doesn't, it's not a huge issue for us with alternatives in our solutions, because we've got a range that you can choose in terms of a low cost through to fully active. And then obviously outside of that, we can make available different alternatives which don't have necessarily the liquidity constraints.
Right. David, a question came through on the use of in-house funds as an alternatives package within broader portfolio set. Is that what Atrium use?
No, we've got
To get
both
exposure?
individuals, and we actually do have a sort of an alternative portfolio that clients can access on managed accounts, but most of our funds also just invest directly.
Right, but clients can access your alternatives capabilities separately.
Yes,
as well.
Yeah. So our
Right.
managed accounts, they're all different line items there under the.
Okay, so obviously it's been mentioned, it's been a very volatile market, and particularly that simultaneous sell-off of bonds and equities this year. So just like to ask Dinyar, how was your alternatives portfolio positioned and constructed in this rising interest rate volatile market environment?
Yeah, sure. So, I mean, look, overall, our portfolios were very defensively positioned going into this, and even in the fixed income space, it was predominantly floating rate. So we avoided, the harm that came to, people who just had lots of duration in there. In terms of the positioning in alternatives, look, whilst we're quite defensively positioned, we don't have a huge allocation of alternatives at this point in time. The alternatives that we do have, basically, bit of trend following in there, which should do well in most environments. We've got some relative value strategies around fixed income in there as well that should be able to capitalise on this sort of an environment. We also have an allocation to precious metals, so gold bullion, and that's there for a number of reasons. I mean, whilst we're in a rising rate environment, we're still in a very low real rate environment. And we think that allocation also serves as a hedge, both as a crisis hedge. It's not an inflation hedge. People get that wrong all the time. It's not an inflation hedge. It is a crisis hedge. It basically hedges against, geopolitical risk, counterparty risk, and basically bad policy making by central planning authorities. So they're the three areas that we've got allocations to in alternatives at this point in time. I'd say it's mid to high single digits in most portfolios. It's not a huge allocation. And again, we're relatively conservative in the way we allocate to alternatives. Obviously fees are something that can be quite high in that space. We do try to keep fees down, but as well, you want the certainty of the outcome. So you want to be really sure that what you're paying for is actually going to deliver you an alternative outcome or a non-correlated outcome.
On trend following, that's been very volatile, like a terrible period. And then the last year or so, it's absolutely rocketed up in terms of returns. Have you always had a position in trend following or managed futures?
We have probably for about the past 7 or 8 years. Over the past few years, we've allocated to the PIMCO trend strategy, which is sort of got a shorter duration focus on its various trends. So there are different flavors in trend following, but that's the one that we've been using.
Okay, Shane, how have you been positioned? Your portfolios?
Yes, so for us, again, start with strategic asset allocation and then dynamic. Dynamic had us concerned about fixed income. We were short duration going into obviously what was a difficult period last year. and the rise in rates. For us, with those concerns, we did have exposure to a relative arbitrage value type fixed interest manager who's not looking to give you exposure to duration or credit, but to give you an exposure to that category, which was beneficial. And so we would look to have access to them based on our views around our strategic asset allocation and dynamic in fixed interest, for instance. We've also had exposure to just a multi-strategy, diversified strategy, who's giving us a real diversified portfolio, lowers the volatility of our overall portfolio, not looking to shoot the lights out, just give us some further diversification. We've had some exposure to some what I'd call long short value type exposure, which is looking to provide again some differentiation to the traditional index, which has become quite growth like, and lots of US growth names in there as well. So that gives us a different outcome and performance characteristics over time. So that's how we've been positioned. We'll continue to review those positions based on our dynamic asset allocation and where we see traditional asset classes being priced, and do we have particular concerns? And fixed interest is a classic example of one that's been underweight and now is well, for us has become more neutral in terms of its relative pricing.
And in terms of looking at corporate bond risk or credit risk, how does your alternatives positioning help to mitigate that risk?
So they're just trying to give you a specific, so for that allocation that we have to fixed interest, for instance, then they're not focused in on giving you an exposure to credit. So there is just another investment avenue that you can get exposure to. So that's how it's being used for us.
Right. David, how are your portfolios positioned in alternatives?
Look, just touching on what Shane mentioned, obviously looking back 12 months ago, duration exposure or duration was very expensive. Equity markets were also, you could say, quite expensive as well. So for us, we had quite elevated cash holdings, but also quite high liquid alternatives for holdings. So, closer to that 25%. And so over the year, we've had, we've currently got positions across a wide range of liquid alternatives. So that includes alternate risk premium managers. So they've been actually able to harness that sort of value premium, which has performed, or that value equity premium that's performed exceptionally well this year. We've had exposure to trend following managers, which have done exceptionally well in these, when you've seen sort of trending markets in currencies and bonds. And so some of them have delivered 30-40% returns over the last 12 months. We've got exposure to currency managers who have also done exceptionally well, given the trending in a lot of currency markets that we've seen also in the last 12 months. And then finally, we've also got exposure to those quantitative macro strategies and long short equity as well. We've got a small allocation. Just on the opportunity set going forward, from our perspective, I think the last 10 years has been very difficult for liquid alternative strategies. And I think one of the reasons for that has been that, central banks across the world have suppressed volatility. And they've probably been able to do that because inflation's been low. And so they've been able to keep interest rates low. They've been able to sort of print money, you can say, which is more or less been a free kick, you could say, for traditional markets like equities and credit. Like, it really didn't matter what equities or credit you bought. The last 10 years, they've all gone up. But for the obviously, we all invest not for what's happened, but for the future. And so looking ahead, and if you look at the inflationary backdrop now, and even if it is waning, it probably, maybe in the US, you could say inflation has peaked. But I think the periods of, or I think central bank suppression of volatility is probably not going to happen like it's happened in the last decade. And I think that's going to provide more trending markets, and it's going to provide, what we think quite a fertile hunting ground for a lot of alpha type strategies that are able to sort of get ahead of these trends and take advantage of what we would say would be an environment prone to more dislocations. So like you've seen with, UK gilt market or with currency markets, we think that's going to become more of the norm, which is what it was probably pre-GFC. And so in saying that, we think liquid alternatives, are actually quite well placed from now, to really benefit from the more dislocated markets that we expect going forward. And so we probably continue to have quite an elevated exposure there.
What do you think are the best indicators of volatility that people should look at? I mean, everyone's pretty familiar with the VIX, I think, but are there any other measures of volatility in markets that Atrium tracks?
Yeah, look, what's interesting is, sometimes you've got some markets that have got like no volatility, and then you've got others like currency markets. So we track currency volatility, we track bond market volatility through the MOVE index. And so it doesn't have to be driven by equity market volatility. Volatility can be driven by, any asset class. And so then we track, I would say, a number of these, broader asset classes in general and their respective volatility. So, at the moment, I would say bond market volatility has been sort of the most volatile market. Maybe currency market volatility is looking like it taking the lead soon. So yeah, I think investors should sort of consider, a lot of the, in considering volatility, just look at it across asset classes.
Actually, Innova obviously has a volatility targeted funds. Do you forecast volatility going in the next couple of years, or is it only very short term?
I think it's
that you're measuring it.
Yeah, we do various forecasts, and I think at the end of the day, we do think that markets are going to be quite volatile over the next few years, and that's actually good for someone that does dynamic asset allocation, because it means there's going to be dislocation in asset valuations, and that spells opportunity for people who have a robust process. So we invite, we're happy that markets will most likely be volatile, and I think as David was saying, central banks are going to have a difficult time sort of reining it in. So it spells opportunity.
Now, a related issue, Shane, is cryptocurrencies and other assets, or I know assets is the right word. Have you had much client demand or inquiries about including crypto in your portfolio?
Yeah, look, I think not necessarily in the portfolios, but just general questions. I think if we only pick up the newspaper last year, when Bitcoins and different things were performing quite well over different periods of time, you get a lot of queries. And it's obviously, for us, it was an area that we didn't invest in or support, etc., for some of the reasons that have come to light. But I think, it's no doubt, like we get in all investment markets, these are things which are in the newspapers. People are asking questions, wanting to participate, etc. So yes, we have had a lot of questions, but we haven't looked to make any investments, etc., in that area.
And just another question for David. As a boutique manager, doing your own due diligence on these hedge fund managers, what's your access like from Australia?
Look, we've got a partnership with LGT. So they're a sort of Swiss investment bank, specialist. So they've got, they open a lot of doors for us. But I would say, look, given the amount of assets in Australia, you'd be surprised at the number of hedge funds that come here. It's huge. And they're always looking for meetings because they're here to meet all the big super funds. And so, and they come here and they spend a week here. So I think access is not that hard. I also think that for a lot of hedge funds, they are capacity constrained. And and also a lot of big super funds are really focused on fees, and so a lot of them don't even have a look at some of these hedge funds, or they're too big to even consider them. And so I think for smaller and medium-sized investors like ourselves, it's a great opportunity because the super funds are constrained by their size and sometimes by their fee budgets. And also the hedge funds also like to have I would say, a diversified client base. And so they love to have, a number of these smaller boutique funds allocating to them. So yeah, the answer to your question is, look, we get a lot of interest, I think. A lot of managers coming through.
And Dinyar, do you get good access?
Yeah, we haven't had any problems with accessing the people we need to speak to. So yeah, no complaints there.
And Shane, I know Oreana has an arm in Hong Kong. Does that help you to see more Asian strategies?
Yes, yes, it does. And I think that this is, for us, the key point as well. So there's no doubt there's lots of strategies out there, as has been highlighted. There's capacity considerations, there's fees, but you need to be able to implement, and you need to be able to implement in a structure which is consistent if you're in a managed account, in the managed account structure, which does reduce the funnel for us quite substantially from that universe. Having said that, if you take it outside of the managed account, it does introduce more opportunities for you without those limitations in place. And so, yes, we have access to a range of opportunities that can be used outside of that particular environment.
Right, and Dinyar, we sort of skipped over a bit the rising interest rate environment. What's sort of Innova's expectations on, when rates are likely to peak, and do you see a soft landing, or are you factoring in more adverse scenarios and therefore looking closer at alternatives?
Yeah, so I think they're going to keep raising rates till something breaks. I mean, they've kind of got to. This sort of inflation is not, the traditional sort of demand-based sort of inflation. It's supply chains and labour market sort of issues. So they're just going to keep raising rates till something breaks, and that's going to create opportunity again. So yeah, sometime next year, probably equity market earnings expectations will be low, and that might create an opportunity then.
David, are you getting much feedback from the alternatives managers you're invested in about what they're expecting about the environment?
Oh, look, they're always positive. They always think they're going to do well. But, we just look at volatility measures and dispersion, and you just look, and it was interesting. We were talking to a UK-based credit manager the other day, and they were just scratching their heads because they were buying UK bank bonds in sterling for about 5% more than buying the same bond but in US dollars. And so dispersion is really wide now across all markets, especially in credit markets. And so that opportunity set, I think, is just going to persist for some time, especially with that rising rate environment, liquidity being drained from the system. You're seeing a lot of forced sellers in the market, who are trying to raise liquidity, those UK pension funds, and that just creates more opportunities. So look, I think, I think the opportunity set for them is really good. Looking ahead for the next 12 months, definitely.
Are you optimistic, Shane, that you've got the right managers to navigate the environment?
Yeah, I think this comes back to the start. It comes back to the mission and objectives that you've got and your investment philosophy. So for us, it's clearly different to the other presenters who each have their own philosophy. For us, it comes back to the mission and objectives of seeking a diversified portfolio, 6, 7, 8% type return over a 5, 6, 7 type period. And so sticking to the investment philosophy and the disciplines is key for us. And that means it's focusing on the medium term. It's acknowledging that there will be some times of dislocation in markets, and you can take advantage of that through dynamic asset allocation. Doesn't necessarily mean you need alternatives, but you can over or underweight particular asset classes. And so we think that's really quite important. Identify the mispriced opportunities, and then in areas where there is significant dislocation and we're concerned about volatility, alternatives, if it's the right manager in the right role who has got an evidence of giving us the outcomes consistently and can do so in a liquid framework within managed accounts, then we'd look to use them. So our time frame isn't in 6 months; it's over 5 years, and so we'd look to navigate that period by looking at all different areas of strategic allocation, dynamic investment selection, which includes alternatives there.
Okay, thanks, Shane. That's well said. Now, I'd just like to wrap up the session. So thank you, thank Dinyar and David, and hand back to Toby.
Great. Look, thank you very much, team. Thank you for what I found a really interesting discussion about the opportunities that alternatives represent for portfolio managers such as the organisations you three represent. It's fascinating to hear the sort of thought processes that you apply to portfolio construction with particular reference to this type of investment. So to those of you who've joined us today, thank you very much. Let me just remind you that the next events that IMAP will have in 2023 are Investec, our virtual technology conference, technology and the role of investments in a 20-year advice relationship. And then in March, an opportunity to spend a day in Melbourne, Sydney and Brisbane, leading investment managers talking about how they attack investment markets. And for those of you who are thinking about the awards, as I say, April's the time. So thank you very much. Thank you to Nigel in particular for hosting this week's webinar series, and to all 9 panelists that we've had join us through this week. We look forward to working with you all next year, and to all of you on the call, have a very happy and safe Christmas, and come back refreshed to interesting investment markets. All right, thanks very much.